They crashed the economy. Millions lost their homes. Millions lost their jobs. $19 trillion vanished. And the ones who did this? They got rewarded for it. This is the story they don't want you to understand. They crashed the economy. Then got paid for it. This wasn't just a financial crisis. It was a slow-motion collapse that had been building for years, fed by greed, built on bad bets, and designed to reward the people at the top no matter what happened to everyone else. When it finally blew up, it didn't just hit Wall Street. It hit the neighbor who lost their house, the uncle who watched his retirement savings vanish overnight, the small business owner who couldn't get a loan. Real people, real damage. And you know what the worst part was? The ones who caused it walked away like nothing had happened. If you were an ordinary person in 2008, you felt the world collapse without any warning. One week you're hearing about rising home prices and a growing economy. The next, major banks are going under, the stock market is in free fall, and your government is handing out hundreds of billions of dollars, not to struggling families, but to the ones who started the fire. To fully understand how that happened, you have to go back a little. The early 2000s were a strange time for Wall Street. The dot-com bubble had just burst. The tech boom was over. Investment banks were sitting on cash and had already started looking for the next big opportunity. What they found was real estate. In America, owning a home wasn't just a dream, it was almost like a religion. And Wall Street found a way to turn that dream into a product. The idea was actually simple. You bundle thousands of home loans together and sell them to investors as a package. They called them mortgage-backed securities. The pitch was hard to resist. Fixed returns backed by real property, spread across thousands of borrowers, with risk supposedly minimized. Investors loved it. Banks loved it even more. But this was exactly where things started to go wrong. To keep selling these packages, banks constantly needed new mortgages. Once they'd lent to all the reliable borrowers, they started targeting people who genuinely couldn't afford it. High-interest loans, adjustable rates that would spike a few years down the line. Mortgages with no income verification, sometimes called liar loans. Whether the borrower could actually pay didn't really matter, because the bank wasn't planning to hold onto the loan anyway. It would package it up and sell it within days. The risk was out of sight, out of mind, or at least everyone kept pretending it was. Behind all of this was a second layer of financial engineering that made everything far more dangerous. Credit default swaps, essentially insurance contracts that allowed investors to bet on whether these mortgage packages would fail. The strange outcome was this: some of the most powerful players in finance were quietly praying for collapse. The worse things got for ordinary homeowners, the more certain people stood to make. And the referees? The credit rating agencies, Moody's, S&P, Fitch, were supposed to warn investors when something was too risky. Instead, they kept handing top ratings to products that were rotten at the core. Why? Because they were being paid by the very bank selling those products. The conflict of interest was this glaring, and this ignored, that looking back it's almost hard to believe. But everyone was making money, so nobody asked hard questions. By 2005, the signs were everywhere if you were willing to look. Housing prices were rising far faster than wages. Brand new neighborhoods were being built in places nobody really wanted to live. People were buying homes with no intention of moving in, flipping them a few months later for a quick profit. It looked like prosperity. It felt like prosperity. But it was a bubble, and bubbles always end the same way. Default started slowly. Adjustable rate mortgages began resetting to higher payments, and homeowners who had barely been keeping up suddenly couldn't stay afloat. Foreclosures started climbing. The value of those mortgage packages began to crack. Then came the domino effect. Bear Stearns went under in early 2008. Lehman Brothers, one of the oldest and most powerful names on Wall Street, collapsed in September. AIG, the giant insurance company that had underwritten the majority of those risky bets, was hours away from total collapse. These weren't small players. These were the foundations of the global financial system, and they were crumbling in real time. Banks stopped trusting each other. Credit froze. Markets crashed. In roughly 1 year, American households lost more than $19 trillion in wealth. Not paper losses. Real money. Real savings. Real futures. Gone. And then came the bailout. The government moved fast, some said faster than it had ever moved, to help ordinary people. Through TORP and a series of emergency Federal Reserve programs, trillions of dollars were pumped into the financial system to prevent a total collapse. The argument was that the banks were too big to fail. Letting them go under would make everything worse for everyone. Maybe that was true, but what came next was very hard to stomach. The banks recovered. Their executives kept their jobs. Some handed out bonuses, with bailout money. Investigations were launched, hearings were held, and in the end almost nobody faced any real consequences. A handful of mid-level traders became scapegoats. The architects of the whole thing largely walked free. Meanwhile, millions of Americans lost their homes. Unemployment hit 10%. Entire communities were hollowed out, and the relief that eventually trickled down to ordinary people was a drop in the ocean compared to what had been handed to Wall Street almost overnight. This wasn't just a policy failure, it was a moral one. It made it pretty clear exactly who the system was actually designed to protect. Now let's get to the part that should keep you up at night. The response to 2008 was more of the same, just at a bigger scale. Central banks around the world slashed interest rates to nearly zero and began pumping money into the financial system through a process called quantitative easing, essentially creating trillions of dollars out of nothing and using them to buy up bonds and other assets. In a narrow sense, it worked. Markets recovered, asset prices soared, stocks, real estate, nearly everything of value went up. If you own things, you got wealthier. If you didn't, if you were renting, living paycheck to paycheck, or just starting out, the recovery largely passed you by. The gap between the financial world and the real world grew wider than it had been before the crisis. Then 2020 arrived. The pandemic triggered the largest economic intervention in modern history. More money was created in 2 years than in the entire decade after 2008. Zero interest rates, trillions in government spending, direct cash payments. For a moment, it felt like we'd broken an old rule of economics, as if you really could just print your way out of any problem. You can't. By 2021, inflation was rising fast, not just in one sector, everywhere. Food, housing, energy, consumer goods. The transitory story central banks kept telling didn't hold. Prices stayed high. Interest rates had to go up fast, which made debt more expensive, slowed the housing market, and rattled financial markets all over again. And underneath it all, the old problems were still there. Record levels of corporate debt, government borrowing through the roof, consumers clinging to credit cards to cover basic expenses, a financial sector that had grown bigger, more concentrated, and in many ways less transparent than it was before the crisis it helped cause. New technologies arrived: crypto, fintech, algorithmic trading, and with them came new ways to package old risks and sell them to people who didn't fully understand what they were buying. The faces changed, the products changed, the dynamics stayed exactly the same. So what do you actually take away from all of this? The first thing, complexity is camouflage, not protection. If a financial product is so complicated that only one or two specialists can understand it, that's not a sign of sophistication. That's a warning sign. Wall Street has always profited from chaos. The more opaque the system, the easier it is to hide what's really going on inside it. The second thing, incentives drive behavior, not rules. If bankers know they'll be rescued when their bets blow up, they'll keep making bigger bets. If regulators know their next job is at a hedge fund, they're not going to be aggressive watchdogs. If politicians are more afraid of a market crash than public anger, they'll prioritize the system over people every single time. None of this requires anyone to be evil. It just requires people to respond to the incentives in front of them, which is exactly what everyone did. The third thing, and this one is personal, financial literacy is no longer optional. You don't need to understand every derivative or swap, but you need to understand the basic patterns, how bubbles form and what they look like from the inside, how risk gets hidden and then suddenly reappears, who wins when a new financial product is being sold hard, and who ends up holding the bag when things fall apart. Because things always fall apart eventually. The music always stops. The only question is whether you're paying attention when it does. 2008 was not a once-in-a-century accident. It was a stress test, and the system barely passed. The core structures that made it possible are still in place. The debt is bigger, the tools are faster, the connections are deeper, and the willingness to let the powerful absorb losses is, if anything, stronger than before. The next shock, whatever form it takes, won't announce itself. It rarely does. What you can do is understand history well enough to recognize the patterns early, to ask the right questions when everyone around you is swept up in enthusiasm. When something looks too stable, too profitable, too well designed to ever fail, that is usually exactly when you should be most skeptical. The system won't protect you, the headlines won't warn you in time, but history will if you take it seriously, and that's exactly why we're here. If this gave you something to think about, subscribe. There's a lot more history worth understanding, and most of it matters far more than people realize. If you enjoyed the video and want to see more, don't forget to like and leave a comment.